Hi, good morning to everybody. Thanks for attending this second Pan-European webinar in collaboration with CME Group. I would first like to thank CME Group for their continuous commitment to sponsoring CFA societies in Europe. As you surely know, CME Group is the world's leading and most diverse derivatives marketplace. CME Group has a strong commitment to the education of market participants, and this naturally led us to organize a series of educational webinars with them. This is the second webinar of this series, but more will follow, so please stay tuned in 2021. And without further ado, I would like to introduce Owain Johnson, Managing Director, Global Head of Research and Product Development at CME Group. His team, the Research and Product Development, develops new risk management products, as well as ensuring the continued relevance of CME Group's key benchmarks. His team also produces original research into financial and commodity derivatives and their underlying markets around the world. So Owain is going to do precisely that. He's going to share with us his views on ESG and derivatives markets. Owain, the floor is yours. Thanks very much and warm welcome.
Well, thank you so much. It's great to be here. Thank you for taking the time to spend with us today. So let's kick off. So you heard a couple of words about CME Group. So if we just flick through the next few slides, you'll see where we came from. So we are in equities, financial products, interest rates, foreign exchange, but also the commodities, energy, agriculture and metals. So we're going to talk today about how the ESG world impacts on all of these 6 asset classes that we have. Right. If you move on, you know, the other thing about our markets is they're a mixture of hedgers, commercial players and speculators, investors. So again, we'll have a little think about how ESG impacts on both sides of the equation, the commercial players and the financial players. Next. Yep, so that's us. That's not me. That possibly could have been my great-grandfather. We're going back a little while there, but that's how it all began. And then if you move to the next slides, you'll see 1972, everything started to get financial. And then on the next one, you will see where we grew to be these giant, beautiful pits, which look so lovely from above. And sadly, most of those have disappeared. And now have a look at us now. That's what the pit has become, this gigantic computer system that matches traders from all over the world. So that's really our journey. That's the background. So let's have a think about ESG and how it affects derivatives and financial products. Before we start, actually, Alex, if you go back one, before we start, let's have a little quiz. See who's awake on this Wednesday morning or Wednesday lunchtime. Here we go. What has been the total green bond issuance so far in 2020? So you have the choice, ladies and gentlemen, 50 to 100, 100 to 150, 150 to 200, or over 200. Those are all billions. So if anybody has any ideas about total green bond issuance, now is your chance. Submit an answer. I'm going to give you 30 seconds. And do we have the results yet? Let's see what people are saying.
3 more seconds.
3, 2, 1. It's exciting. The tension is mounting. Right. Well, I'm afraid 87% of you are wrong. It is over 200 billion. So happy days to the 13% of you that are right. And I would just want to say, look how big this market is getting, right? Over 200 billion in green bonds so far this year. It's fair to say that 87% of you didn't expect that. So we really are talking about something that's growing, something that's building, something that's really happening. All right, so if we go to the next slide, we will see partly why that is happening. So really what's happening, if you move on the slide, there we go. Actually, before we talk about anything to do with 2020, we should just check that everybody's clear what we're talking about. Sorry, ESG, environmental, social, governance. I'm sure you are all aware of that, otherwise you wouldn't log on to this webinar. But that's what we'll be talking about today, is that set of standards that we're using to screen investments and evaluate performance, not just of companies, but also products, of commodities, you name it, really. It's a screen of good things that we place over the products and services we deal with. And that's really becoming a bigger theme this year. So you'll see on the next slide that 2020 has really seen an impact from investors, particularly. They're really, really starting to talk about ESG. So there you go. You got BlackRock particularly saying we will vote against boards and managements that do not make progress on this issue. So there's really getting a big push from the investor side on ESG. That's really stepped up this year. So you're starting to see that if you look at this, 100% of institutional investors are calling for that, and they are asking for sustainability initiatives to be embedded. 100%. That's pretty clear what investors want. I actually am spending more and more time on CME investor calls, talking to our investors about what we're doing, and this question just comes up again and again and again, and that will be the same of every company that you deal with or that you work at. Your investors are starting to ask what you're doing in this space. So it's a great topic. So let's have a look at the next one. So the reason people are doing this, I think we need to be honest with themselves. There are some wonderful business leaders out there who believe in sustainability and social justice, but there are also some who believe that this is a great way to grow revenues and to grow their share price. So I kind of like to say, it's not as important whether you yourself believe in environmental change or whether you deny environmental change. That's not really the issue. The issue is, what do your investors expect from you? And also, there is factual evidence that having this review of ESG within your company adds value. So investors are prepared to pay a premium for companies that pay attention to the environment or to social or to governance. So this really is, McKinsey's calling it the ESG premium. So again, your personal beliefs, your private thoughts about ESG, not that relevant. It makes total business sense. Investors are asking for it. Investors are paying a premium for it. So that is very, very important to know. All right, on we go. It's all over the media. I just pulled up randomly a bunch of headlines from the last few days. This is the social impact. I know in the CFA Society, you like to talk a lot about the social impact of what you do and your role that you can play in society to improve things. You can see that the pressure is coming in, that the media attention is there on companies, on the private sector, on shareholders, on investors to do something about this. Yeah, we've got a real driver. So it's not just here at the exchange. We can help by creating the products that you guys can use and the customers can use, but the pressure is on all of us and all of you to be aware of this social driver, and it's really coming through in the media, as you see. Right, on we go again. So derivatives, we're all over it. The derivatives world is pushing into it. The World Federation of Exchanges, the CFTC, which is my regulator, the Futures Industry Association, the FIA, and then the United Nations has created this thing called the Sustainable Stock Exchanges Initiative. So that's come down from the UN. It's been driven out of Geneva. There is a big body of work on equities exchanges already, how they can improve disclosure in their IPOs, how they can improve environmental reporting. But for the first time this year, they've started looking at derivatives as well. So beyond stock markets into derivative markets. And I'm happy to say we are co-chairing that, myself and my boss. So we're working on that a lot. And that will also produce some guidelines, some rules of the road for derivatives exchanges that bring us into line with the rules of the road that exist already for equities exchanges. So that's a big piece of work. You can see there's a real driver from the regulation, from the UN itself, and within the industry. So this is something, again, people are taking very seriously. Right, onwards. So obviously we are, be crazy if I'm standing here and we're not. So we have done our own sustainability report. You can read all about it online. We're getting more and more questions, as I said. Every one of you will. And if you don't have a report like this, I'd encourage you to think about developing one, because it's really, really significant. And it really helps when you get those inbound questions from your customers, your suppliers, your end users, or even your regulator. Right. So 2020 ESG, what's changed? Let's take a look at that specifically. In the first quarter of 2020, we saw asset outflows from virtually every type of investment fund, because people were wanting to hold cash, people were suffering, markets were too volatile, except for ESG. So ESG, actually in the first quarter, when we were all in the COVID pandemic panic, they were seeing investment inflow. So I think, if nothing else, that is a really huge sign of what we are talking about today, which is the impact on real fund flow, real investment potential in ESG. We are seeing massive inflow, and we're also seeing outperformance. So this is another factor. Again, I was saying to you before, it's not just about whether you believe, whether you're an environmentalist or not. If you bought the S&P ESG 500 at the start of the year, rather than the normal S&P 500, you would be receiving a premium, because the parts of the ESG, so where ESG focuses is a lot obviously on non-resource firms. So let's say your Amazons or the kind of IT firms that have a lower environmental footprint than the miners, the oil companies. Now, over the last year, obviously, it's no surprise to any of you, they've massively outperformed, right? So the oil companies, the mining companies have suffered under COVID. We're not flying, we're not driving. And the virtual companies with the smaller carbon footprint have done a lot better. So there's been a noticeable outperformance financially in the ESG side. So that's really helped. So not only do you feel better about investing in ESG, you're actually performing better about it. So that's a really key thing, and that's something that's really new in 2020, that massive outperformance. It's given that alpha that we didn't see necessarily before. Before, people used to say, I'll invest in ESG, but I don't want to take the penalty. Now they're seeing a premium. So that's really driving this inflow of funds. All right, onwards. So I've given you hopefully a bit of the background on why ESG matters, what the industry is doing. Now I thought we'd move through the asset classes and talk specifically about agriculture, energy, metals, foreign exchange, interest rates, and equity indexes. So the 6 big asset classes, we'll have a think about how ESG impacts on each one of those 6. So start with agriculture. There is a new focus on the different aspects of crops. So when people used to talk about wheat or corn, they used to talk about the protein content or various other attributes of that wheat that were to do with its use in food. Now they're talking about attributes that are to do with its production methods. So you'll see carbon intensity. Is it genetically modified? How much water did it use? Was it created in a field that was the subject of deforestation? Do they step aside land? What's the wildlife policy of the farmer? So everything has changed in a way, or everything is beginning to change, in that wheat now has its intrinsic component, but its extrinsic components as well, the ESG attributes. Very, very important. So it's a big change, and the change that agricultural sector is trying to get its head round. So that's happening with some of the European and US crops. Some of the other crops are just coming under a lot of pressure. So crude palm oil is a good example. Soybeans in Brazil, good example. Those are coming under a lot of scrutiny because of the deforestation impact that they have. So that's a real change that we're seeing there. One of the interesting factors there, though, is one of the things that concerns us a little bit is you might just get vertical integration. Because if you are Nestle, or if you are another big food producer, maybe in order to have vertical oversight on the ESG components. Like, so you might want to now own the farm yourself, own the shipping yourself, own the processing yourself. So much more vertical integration than we've seen in agriculture before, because those companies are so worried about the reputation. So that's a trend that makes us a little nervous, because you will get less price discovery and less kind of open markets if it goes that vertical way. New markets are emerging. People are more interested in hemp, which is a really interesting one because it's got a low environmental impact, hemp. Water is one that we're launching yesterday, I think. Anyway, certainly this week, we have water futures for the first time ever. So first water futures anywhere in the world. Why are we doing that? Because people are talking a lot about water scarcity. How do you value water? So one of the guys said to me, at the moment, water is allocated by litigation, by lobbying, and it should be a market process that allows the people that need it to access it without 50-year rights that have been granted by some previous local government. So we're trying to bring a bit more transparency to that water. So there's a whole lot going on there in agriculture. Happy to talk more about that. Let's move on to the next one, which I think would be metals. Right, metals, another big one. I mean, all these asset classes are impacted. A lot of recycling in metals. Great thing about metals, semi-infinitely recyclable, right? You can, the same gold that the Incas we're using today, it just gets recycled. So in that sense, metals has quite a good profile, but the actual mining side of it, the original mining, obviously is very problematic. So you have to think heavily about the impact of the mining. So we're very focused on the recycling at the moment. We've got US ferrous scrap and Turkish scrap. So scrap steel, where you re-smelt the steel. And we're looking at used beverage cans for aluminium. So when you take your Coke can and you finish it, you throw it away, that can be infinitely recycled. And aluminum is a very, very intensive production process. So recycling that is great. So we're looking a little bit at that. So, and some of the European producers like Hydro in Norway, they're increasingly using hydropower, Rusal in Russia as well. So then you get a lot lower carbon intensity from your aluminum. So you can feel less guilty about drinking your Coke. Certainly on the environmental side, I mean, your health, that's a different story, but you can feel a lot less guilty about what you're doing to the planet if you drink a recycled can or a can that was produced with hydropower. There's also a big focus on responsible sourcing. So as I said, the mining side can be quite problematic. So what we want to do is check that those mines were produced in line with best possible standards. So we have this responsible sourcing program that is run by the LBMA on our behalf, and that's for the precious metals. We also have a similar thing for cobalt, which is something we've launched recently because of battery metals. So we like to screen those metals. Metals can be quite challenging. It's great to have a screen on them. Lithium and cobalt, big focus going forward. So one of the things that those metals will do is help drive that electric vehicle revolution, which we'll talk about in a minute. So cobalt, again, we're launching either this week or next week. Right, lot in metals, again, happy to take questions. Let's go on to look at some of the energy products. So the elephant, obviously, in the room for energy is carbon emissions. So Paris Agreement, and I wish I was in Paris now. Well, I was here this time last year. I would rather be there than in my study. But the Paris Agreement, very, very important. Emissions markets are mature in Europe. They're developing in California. We're seeing greater interest from President-elect Biden. We're seeing interest from the Chinese. We're seeing a lot more interest in voluntary carbon offsets. This is a market that's only going to grow. What we really need as a planet is a global emissions market, or a market where you can transfer emissions between different countries or between the EU and US. This is still a long way from happening, but there are signs that it might. For the first time, you can be a little more optimistic about that kind of linkage between different countries and different trading blocks. So I think that's really positive. We're actually starting to have a conversation about carbon pricing, carbon emissions, carbon futures for the first time really, in a few years, it's been off the agenda. So that's super exciting. We're very keen on that. Right, next one I think is bioenergy. So just if you're not clear what bioenergy is, it's when you take usually a waste product like a recycled cooking oil from a restaurant. So you take the oil out of the fryer in the restaurant and you process it and you put it into diesel. So if you're in Europe right now, you are potentially driving a diesel car, and your diesel car or your truck will be running on a very small percentage of biodiesel, maybe made from a soy or from used cooking oil or from a rapeseed oil, but there will be a small component in your gasoline and your diesel of organic material. They're also using organic material to replace coal, so burning wood pellets, burning waste from the agricultural process. When IKEA make all those bookshelves and they have little bits of sawdust, that gets packaged up and that can go into power generation to compete with coal. And you'll see from this little note that I put at the side that Europe is pushing hard on this. So renewable fuels mandate from 14% to 24% by 2030. So the political will is there. There's a really strong drive on this from the EU particularly. UK is also going to follow the same path post-Brexit. Bioenergy, big focus. So that's one that's going to grow. If anything, we're short of the bio. We're not short of the demand. We're short of the supply at the moment. So that's a big area. Right. Next one. So very interesting. So I don't know how many of you have got an electric vehicle already, or a plug-in or a hybrid. It's growing like crazy. So I just put some fun facts here. 7.5 million EVs on the road right now. 10 years ago, 20,000 sold. Today, we're selling an EV every 15 seconds. You saw that Tesla, the share price of Tesla has gone up 6 times so far this year. They're about to enter the S&P 500 for the first time. The electric vehicle revolution is full speed ahead. 6 out of 10 in Norway. Biden's going to put in 500,000 EV charging stations. But if that happens, and if the will is there in the US, people see 25 million EVs more in the US. This is a massive, massive change. And I think, you know, the stat that struck me from that really was about China. You know, we tend to think prejudice about China is that the environment is a second impact in China compared to the economic development. But you can see half the world's EVs are in China right now. That's amazing to me. So the Chinese are really full speed ahead on that. Big change, really good. So within EVs, the one thing that I would point out is your EV is only as clean as your electricity. So if you're living in Germany and you're running an EV, you're running your EV a lot of the time on brown coal, lignite, because that's what's making your power. So your EV is only as clean as your power source. If you're running it in France, it's most likely coming from nuclear. If you're running it in the UK, it's most likely coming from natural gas. But your EV depends on the power that goes into it. And we would all love to see wind power, wave power, solar power to power our EVs. But the reality is there are days when the sun doesn't shine, when the wind doesn't blow. So at that point, you need something like nuclear or nat gas, which is a bit cleaner than coal or brown coal, to power things. So natural gas is probably going to be the big winner over the next 20 or 30 years. Coal is going away slowly in Europe. It's going away less slowly in Asia. It's going away quite quickly in the US. So coal consumption, I think, declined last year for the first time since the Industrial Revolution, pretty much. We're seeing the tipping point for coal. Natural gas is increasing. Natural gas plants are cleaner than coal plants. They're cheaper. There's more nat gas around coming out of Russia, Qatar, Australia, the US. There's a lot of nat gas in the world. So whenever you have that problem with renewables, you flip on your nat gas. Every megawatt of renewables will be backed by a megawatt of nuclear or nat gas. So anyway, big trend, electrification. Let's have a little look at that on the next slide. So if you want to take a position on the electric vehicle revolution, if you want to invest in the electric revolution, you can buy Tesla stock. You can buy the S&P because it's now got Tesla in it, or it will have next Friday. But you can also take a position on the commodities that will benefit. So battery metals, cobalt, lithium, palladium, platinum, those all goes into the battery. So you can take a position on those. If you believe that demand for electric vehicles is going to continue to surge, then demand for all of these commodities will follow it, right? So you want to be long cobalt, long lithium, long palladium, and long platinum. The same, there's an interesting trade in the bodywork. So the body of the car, the bodywork, your traditional big SUV has a lot of steel in it. It's a big heavy car made of steel. Most of the EV, then pushing more towards aluminium. It's lighter because the battery is heavy in an EV. So they don't want the bodywork to be as heavy if they can. So they push more to aluminum. So again, you could trade the aluminum versus steel spread. There, if you thought that there'd be less steel in the car manufacturing process, more aluminium, there's a spread there. Or you can just go long aluminium. Copper, not just in the circuits in the car, but in the charging stations. You saw Biden's talking about 500,000 new charging stations. All of those have copper wiring. If we're going to add a charging station every 50k throughout Europe, throughout the US, throughout Asia, that is a lot of copper. So again, copper is going to be really key. You might want to think about that. And as I said before, generation fuels, nat gas, coal, uranium, and electricity, that's what actually powers it at the moment, along with the renewables where possible. But yeah, there's a lot of ways that you can play and invest and take positions in the revolution, apart from just buying stock. So, you know, that's what a lot of our investors are talking to us about. A lot of the hedge funds are trying to work out these plays, Tesla stock versus cobalt, physical lithium, there's no lithium derivatives yet, physical lithium or palladium futures versus Tesla forward prices. There's a lot of different ways people are thinking about this. It's quite an interesting trading sector, new sector. Right, I think, is that it for commodities? Let's have a look. Yes, it is. I was right. So we're going to shift gear now. That was the world of commodities in a short period of time. A lot we could talk about. Happy to take questions. Let's change gears now, talk about the financial side. So the financials, again, is interest rates, equity indexes, and foreign exchange. So let's have a look now at how ESG is impacting on all of those. Right. I talked to you briefly, I mentioned like the ESG 500 and how that had outperformed the traditional ESG, traditional S&P. So let's just drill in a little deeper on what that is. So the S&P 500, it excludes weapons, tobacco, any company with more than 5% of revenue from coal, and firms that have a low score on their development goals. So generally a low score. So this is an exclusionary method, a screen method. It takes out a lot of these guys. So you'll see that the returns on it have been slightly high. It's very similar in its tracking to the ESG, broad ESG index, until really this year when we started to see some outperformance. But this is a way of taking the same exposure to a broad-based set of stocks in the US, but you get the ESG boost. You just go to the next slide and you'll see, again, sorry, Alex, if you can just go one forward. Thank you. You'll see there that the ADV is 500. I mean, that is very low compared to the real non-ESG 500 S&P, but it's also one of the best launches we've had recently, and it's now the biggest ESG future. So that just keeps growing. It's now 2 ticks wide to BPS, they call it, 2 ticks wide. There's $750 million now invested in that in the notional sense. We are hoping to see that get to 1 billion quite quickly. So again, a tiny young baby compared to the original S&P 500, but growing very quickly, tight pricing, a lot of people using blocks as well as on the screen. And the kind of questions we get are, the problem with ESG investing, in a way, if you just allow me a brief diversion, is that every investor and every hedge fund wants their own type of ESG. So we go and see this one guy and he says, well, I'm going to exclude all coal production. Any firm with any exposure to coal, I'm going to exclude it. The other guy says, no more than 20% coal. The other guy says, no more than 10% coal. Everybody's got their own definition. There's a real problem for this ESG sector. Everyone wants to define it themselves. Why do they do that? Because maybe they believe more in the S than the G, or they believe more in the G than the E. But also, they do it for commercial reasons, right? Because they want to attract funds into their fund. So they want to say, my fund is greener than his. My fund is more socially aware than hers. It's a way of attracting that investment flow, which is great, and that's totally legitimate. The problem we have then as an industry, all of us, is that there's not much standardization. So the problem we have is, what's the standard? What's the broad-based agreement? Okay, you want to go more green or less green, but how do we define green? So I think one of the nice things about the S&P 500 ESG is that, love it or hate it, it is an attempt to provide a middle definition. It's not going to work for everybody, but it's the best benchmark we have right now. And so it's useful for benchmarking, and it's a good hedge for whatever cash position you have. Your cash position might be more green or less green, but this is a broadly equivalent hedge. But it's an interesting concept, this lack of standardization. And again, happy to talk about that. Right, what's next for us? I think we're getting there. Foreign exchange. You might think, well, and I did think, there can't be much green implications for foreign exchange, right? Foreign exchange, euro to dollar, yen to pound, Swiss franc. How would the ESG world impact on that? Fair enough. People are starting to think about it though, and people are actually starting to create projects around this. So you'll see on the left that Refinitiv, which is the old Reuters, they're starting to create these sustainable development scores for countries. So each country gets a ranking. Let's say, I know, Denmark is one because it's great, it's got loads of wind power. So they get top points. So you might then want to take more exposure to a particular currency because they score very highly. So what we're hearing is customers maybe trying to trade the spread. If I think that Saudi Arabia has a bad ESG score, I can sell the real against the Swiss krona or whatever you might want to do. Terrible examples, but people starting to trade baskets of high scoring currency against low scoring currency on the basis that over a longer period, the countries and the currencies that have got the best sustainability will have a better economy going forward. Or the other thing we're seeing is governance. So people are starting to think about central banks. So let's say the Bank of England is very independent. It sets its monetary policy for the benefit of the UK. Good score. The Central Bank of Turkey has a lot of political influence. Bad governance score. So could you trade governance within countries? Could you make a bet on how that central bank governance will impact on those performances of currencies over the long term? A lot of people are talking about that. Early days, but very interesting. The other thing that's happening in foreign exchange is that the banks are starting to lend money with, or hedge FX for you with a ESG framework. So, for example, you go to your bank and you say, I want to do 300 million euro yen. And he says, okay, the market is X at Y. But if you are using that currency exchange to do something green or to improve then I'll give you a tighter market. I will give you a better price for that foreign exchange if your proceeds are going to do something great. So if you're a Spanish wind farm and you want to do euro for Chinese yuan because you're buying in wind farm or solar power components from China, well, I'll give you a better price than if you were trying to do that to buy in plastics or coal or whatever. So the banks are starting to push their customers by giving them better pricing for FX if there's ESG. So I think really interesting. Right, on to interest rates. Yeah, fixed income. Green bond issuance, over 200 billion, you all know that now. So congratulations, you've learned that today, if nothing else. 200 billion this year so far, and we've still got 2-3 weeks to go. The European Union has said green bonds are a priority instrument. So green bonds, you have to use that proceeds from the bond to do something good. You can't just use them on standard business as usual. You have to improve your carbon efficiency. You have to improve your governance, improve your social standard with the money from the bond. So you can see that is a rising trend. And a lot of countries are starting to use sovereign green bonds. So they will issue green bonds, Germans, UK, Scandinavians, and they'll use that money to improve, for example, to lend money or subsidise electric vehicle charging, to subsidise better insulation in houses. So the governments themselves are doing a lot of this. This is huge. This is going to get bigger and bigger and bigger, green bonds. Every day there's something new on green bonds, and we're getting green bond indexes now, green bond ETFs. It's really fast growing. If you haven't looked at this sector, really, really interesting. This is a booming area. All right, now I think let's have a look where we've got to. Oh, there you go. You're nearly there. Next steps and conclusions. Right, let's have a look. What are the customers telling me and CME Group? We're in the middle trying to create these markets, and we're getting feedback from all the customers. So what are we hearing? Well, the hedge funds and the asset managers, they come to us a lot and they say, can we trade your gold product? Is it sustainable? Yep, it's recyclable and it's screened. You know, they want to know what they can trade that fits within an ESG mandate. What's liquid? What can I use? So that's a typical question we get from the investor side. They often have a specialist desk within the fund or the pension fund, the asset manager, whoever it might be. They often have a specialist ESG desk, and those guys are really keen to find the right kind of products they can use. They want liquidity, but they also want something very green. The commercials, the corporates, the big firms, the big producers, the kind of food companies, the energy companies, those kind of guys, they're not focused on the wider world, they're focused on their own world, obviously. So, you know, if we talk to a food producer, he wants to talk deeply about ags, and they will do very niche, like swap futures that are brokered. They don't care about liquidity. They just want very niche targeted hedges. And they all want to talk to us and to each other because they're all worried that they're getting left behind. BP, for example, is out there every day talking about their ESG transition. It makes all the other oil companies nervous. Are we missing something? So they all want to talk. They all want to find out what the other guys are doing. So there's a lot of fear of missing out in that sector. And the banks, interesting with the banks, they tend to also want to ask us very broad questions also about how much we fly, what percentage of our management is female or from an ethnic minority. They want a very holistic view of all their partners. So the banks are spending a lot of time and resources on having a look at all the people they deal with and what their profile is. So that's a really interesting space. They also often have specific mandate, as I'm saying here. They want to know they want to not just know who they're dealing with, but they want to be actively the first guy to do that trade. So you saw people like Deutsche Bank want to do the first ESG trade. Société Générale, BNP, these guys, they're the French banks, the Dutch banks, very focused on it. Standard Chartered, they push a lot, particularly the European banks. They want to be first in these ESG products. All right, one more. I've nearly tested your patience to its limit, but I firmly believe this. The impact of ESG will only continue to grow. Hopefully you've got a little idea of that today. You've seen it on the electric vehicles, you see it on the green bonds, you see it on all the scrutiny that's coming. This is happening more and more. we get investors phoning up, can we speak to your head of ESG? Firms are getting ahead of ESG. 2 years ago, no one, maybe one or two guys in the whole world. Now everyone's getting ahead of ESG. The EU's putting some great standards in place that will help get this sector up and running. So we're really, really bullish on this sector. We see nothing but growth going forward. Emissions trading, the US elections are pushing that agenda further forward. Massive. So hopefully giving you a little sense there of why we're excited about it. I hope you're excited about it too. And again, it's not about your personal beliefs. It's about this is the way the world is going. So you can't really fight that. Don't stand in front of the ESG train because it's just coming down the tracks. Right, I think I might set you free at this point. Let's have a look. Did I have anything more to say on the next slide? No, I didn't.
Thanks,
I was just
Owain.
thanking you. I do thank you.
We do have a couple questions coming in the chat, but beforehand we did have a second polling question on electric vehicles. Do you want to go ahead and do that right now?
This question is more of a test about whether people were listening, right? So how many vehicles are on the road today? 1 to 4, 4 to 7, 7 to 10, or over 10? I'll give you a minute to make your mind up, and sadly there's no prize for the winner. If you get both of them right, you get a feeling of great satisfaction then. Tell me when you have the results, Alex.
All right.
Oh, well done, a third of you. 7.5 million is the answer. 7 to 10 million is the winning one. So we're getting our improvement is higher. We're getting up there. So that's great. From 18% of people being right to 33% being right. Soon we'll be on to 100%. This is brilliant. Well done, everyone. All right. So, questions?
Yes, so we have a first question coming in the chat. So, how the liquidity compares between regular S&P 500 futures and ESG S&P 500 futures?
Honestly, not so great. I would love to tell you better. It would be a single-digit percent of the overall liquidity in the parent contract. The only thing I would say to that is it's growing quick. So ask me 6 months ago, it was worse. Ask me in 6 months' time, it will be a lot better. And there's good liquidity, not just on the screen, but there's liquidity in the block market. So often people are phoning the banks and doing blocks rather than looking on the screen. So there's quite good, you can always get a trade done in it, put it that way. It's 1 to 2 ticks wide, but the volumes are nothing yet like the original. But then the original is gigantic. It's the most liquid equity future on the planet. So the comparison is pretty hard for that product. It's growing very nicely.
All right, so next question. What other ESG derivatives do you have in the pipe?
Oh man, I can't tell you all my secrets. Let me think. So I really like the bioenergy space. I like hydrogen a lot. I think hydrogen is really interesting. We haven't really mentioned that so far. Hydrogen is naturally occurring or produced through electrolysis, and when you burn hydrogen in your car, you just get water. So that's the fantastic thing. There's no vehicle emission from hydrogen. It's very small molecules, so you need to do some work on it. It's not as easy as all that, but you can move it around the world. In a hard form, it's ammonia, so you can move hydrogen around the world. So the Japanese particularly really like hydrogen. They're thinking of getting it from Australia, where there's a lot of production, and the Australians will ship solid ammonia across to Japan. Japan will regasify it. They've got quite a few buses already, hydrogen buses and hydrogen taxis. Hydrogen's a lot less dense than gasoline, so you have to fill up more. So it works better. It works really well for cabs, for taxis, for buses, but it may work for domestic. So we may be able to change the existing natural gas pipeline that runs to your house to carry hydrogen. That's a big maybe, but that would be kind of cool. So hydrogen I'm really interested in. I would like to see something develop there. I think equity indexes, we're getting asked whether we could do options on the S&P ESG. We're also getting asked whether we could do the Dow Jones Industrial Average with an ESG screen, like the FTSE Russell with an ESG screen. So we're starting to get asked about different indexes, which I think would be cool. But let's just get the S&P really firing first. Like that would be a second order thing. And then you saw, I'm pretty psyched, as the Americans say, about green bonds. So I'd love to do a green bond index or some green bond futures, maybe, you know, that might be one for 21 or 22. Right, don't go and tell all my competitors all that now. Thank you very much. Giving you all my secrets.
Thanks, Owen. So next question in the chat from Ola, who thanks you for your commitment and shares the idea of participation and revolution that markets provide. The last rise in investment area of ESG bonds based on all of these values is financially attractive, mostly from perspective from issuers of these bonds. What is your belief about returns on such type of assets because of growing interest and low yields?
Yeah, that's a great point. It's a tough market out there, as you know, and as Ola says so correctly. This is not a great market for fixed income right now, where everything is flat forever. So as an issuer, if you can attract a slight premium from an ESG bond, why would you not want to do that? You know, there's so much hunger for these bonds. I mean, the governments and the corporations are doing it not solely from their wish to make the world a better place, but because you can actually get some decent premium from it. From an investor's point of view, you're obviously paying the premium. So again, it depends on your mandate, whether you think that's worthwhile. We're not talking about huge sums of money in the difference. We're talking about tiny bips on the premium. So again, you're not paying that much more, but that you can satisfy your mandate and you can tell your investors or your bank supervisor that you have this big exposure now to green bonds. I think it's working quite well. I haven't seen a green bond issuance that hasn't been snapped up. So we haven't yet saturated the market. Like I was saying, you saw how much we've done so far this year, and that's been easily absorbed. Let's see next year when there's a lot more, whether the market can continue to absorb all these green bonds. My suspicion is it can, absolutely.
Thanks, Owen. So next question. A regular position of ESG investors is to exclude grain futures as eligible investments because of potentially making food more expensive and trigger starvation. What's your view about making useful metals more expensive for the EV transition through investing in futures?
Yeah, I've never really totally understood that logic, because for every buyer there's a seller. So I'm not sure why people would think that taking a position, I mean, they don't have to take a long position, for example, they could take a short position. I never totally got that one, but I don't think there's much to say that adding a futures market has much impact on the spot price, because the spot price ultimately determines the futures price. So what's going to determine the price of cobalt and lithium is the availability in the mining sector and the demand from the EV sector. Whether or not there's a futures on that, I don't think will impact, except that, and this is quite a significant point, the lack of a forward curve deters investment. So if you do not have a forward curve in agriculture, farmers cannot make the correct decision on what to grow for the next year or the following years, because they do not know the relative value of grains. So you require the futures market to send those signals so that the agricultural market can work correctly. In the same way, one of the issues that we hear from the banks about funding battery metal developments is they do not have any view on prices going forward. So if I want to develop a Argentinian lithium production site and I go to JP Morgan says, I don't know whether lithium is going to double or half next year, So this appears to be a very risky investment, very hard for them to get the financing. The moment there's a forward curve, and JP can say, okay, so it looks like this market is expected to rise over the next 3 to 5 years. That looks like a reasonable investment. In fact, if you want to get even better lending terms from us, we suggest you hedge a third or a half of your potential income so that we can lock that price in, and I know you're going to be able to repay us. That's where it works really well. So bringing that futures market and that forward price transparency is absolutely crucial to getting projects funded today. Very important.
Thanks, Owen. So we do have just enough time for one last question. So coming in from the chat from Gulshat, do you have an outlook on global supply of metals in general and supply of metals used in energy transition specifically?
Oh, Gulshat, you're asking me the tough ones, aren't you? The short answer is no, not really, because it's incredibly hard to predict, and there's a lot cleverer people than me. The one thing we would say is that you'd be surprised how cobalt prices haven't really picked up that much. If you draw a line of EV production to cobalt prices, or Tesla share price to cobalt prices, cobalt's been pretty thin. Cobalt lithium actually come off quite a bit. And I think that's to do with the increase in supply. So I am a big believer that in metals, particularly, it's about the supply. Because there's not that much storage of those battery metals at this point. It's not like that, you know, in copper or gold, there's incredible warehouses and vaults full of the stuff. So things just move in and out of storage. You don't really have that yet for battery metals. There's not many people taking a position to hold battery metals. They tend to come straight out of the producer into the processor, into the car company. So I would watch the supply side very carefully. And you know that a lot of that stuff, particularly cobalt's coming out of the Democratic Republic of the Congo. So you want to watch the political situation there very carefully.
Thanks, Owen. Alex, the floor is yours.
Thanks a lot, Mary-Lex, and especially thanks a lot, Owain, for sharing your time and your knowledge. It's been a very interesting, very lively session. I enjoyed both the presentation and the Q&A, so thanks very much for that. Let us remind you that both the recording and the presentation will be shared with all the participants and all our members. A very quick reminder that our next webinar will take place on December 16th. It's about insurance and how to tackle private equity and responsible investing for institutions. Another reminder, CFA Society France is fully committed to ESG. We have a very active ESG committee, and we are promoting the certificate in ESG investing. So should you be interested, all the information on the website is available. And really a big, huge thank you to everybody for your time. Please stay safe. Please enjoy your time until Christmas. And let's hope that 2021 will be slightly different than 2020. Looking forward to it, and looking forward to keeping in contact with you, Owain. Thank you very much for your time.